And with that, we're going to move on to our first ever ag-focused panel. So I got to give Andrew a little credit. This was his idea. Unfortunately, Jason Copeland just texted me. He was not able to get compliance approval in time for this. So he's not allowed to join. Hopefully a lot of you guys got to see him speak last time on the institutional investor panel. Jason manages about $30 billion for Highland Associates. They're a Birmingham, Alabama-based consultant. But we do have a fellow Southern luminary here with Joe Wade, who I see in the audience, but I assume he'll be joining us on stage. Actually, sorry, Joe is next time. You got to wait for Birmingham. So for now, we're going to talk about COVID and demand changes in energy, agriculture, and the economy at large. Andrew Warwick from Typhon is going to be guiding us through this. A lot of you saw Bernie present earlier. He's a portfolio manager at County Cork. And we got Jared Lehman, who has been trading ag for Typhon for over 10 years now as the Plutus greatest grain strategy. So Andrew, take it away, bud. Unmute. Don't be a boomer. Unmute.
Thanks,
there
guys.
We go.
Really glad to be back and have you all on the panel for what turns out to be probably one of the most momentous year in a long time in terms of commodity trading. There's all sorts of, just when you thought you had supply and demand figured out, all of your coefficients and ratios ready, out of nowhere comes COVID, and it changes everything that you could possibly want to know about demand. So I'm hoping that you guys can, sort of walk me through how COVID has affected both the supply and demand and prices of your market, and sort of where we go from here. And so I don't care, one of you guys want to start off and maybe just talk through how the year has played out in terms of supply and demand, and then we can sort of dig into it deeper.
Jared, why don't I go first then? Okay. So if we think about it, obviously what happened in March and everything got thrown into a conniption. We thought that, my God, nobody's ever going to drive for a while. So the ethanol demand basically disappeared. But what we did find at the time is how receptive people are to changes in their own demand structure. So once they started to get overloaded with corn and basically overloaded with ethanol, it's amazing how fast they got down to a level that they could manage their current business from. Most of the people managed their current business in that space at a loss, but they still operated. I don't think we had as many people leaving the industry as we thought. The other thing is that so much of the ethanol crushing industry is dominated by farmer co-ops. So a lot of times you get these farmer co-ops, and they thought basically because of what they saw in 05, 06, 07, that this is a great way to make money, but they're not efficient enough. And then when they see these negative margins, they get smoked. But the thing about it is that I thought that was really interesting is how quickly people basically were receptive to be able to manage their own inventory. Now we take that at the same time that a year ago in 2019, we had these floods. And so basically the whole ag space, we couldn't plant for a long time, basically out into mid-May. Corn ran into $4.50. Beans rallied not quite as much, but they rallied really strongly. And then we found by the USDA in the subsequent reports as we went into harvest that the yields were better than they thought, and the actual harvest was better than they thought. And the market went down, beans went down back to $8, corn went back down to $3 in April, May. But what really happened, and obviously they were like, okay, we don't have demand and we have too much supply, and we're looking for 3.3 billion carry out in corn, and we're looking for 450 million carryout in beans. But the USDA had it all wrong. They were based on all their estimates on what they thought were good numbers. And as we've gone into June, July, August, September, and November, every crop report has reduced last year's inventory. So it's kind of a confluence of events. You've got the general population thinking we have more grain around than we had. And we have obviously this lack of demand, so we push prices down. And then what turns out is we didn't have that low, that high amount of grain inventory. We were actually much, much, much lower. And we had prevent plant acres that we couldn't get back into the field this year. Couple that with the Chinese buying, and all of a sudden, whatever thought we had about COVID early got completely flipped around. And I think it's because people started to manage their own inventories better. No one wanted to get stuck with crop that they couldn't own and sell. And the same thing in the energy space. So I think that it's really been, it's not just been a COVID environment, it's been a COVID environment where we didn't really truly understand, because of the previous year, the true supply and demand of what we have.
Well, that's a lot of stuff for us to dig into after we hear from Jared.
No, I agree with you completely, Bernie, about the USDA and changing numbers throughout the year several times, caught several guys, farmers, end users, everyone in between, really off guard. And we have several people that were kind of caught way out of position. Listen, last January, we just signed the China trade deal. And then within a week or so, we get COVID news. We saw prices drop, like Bernie had mentioned. We had gotten a crop report that was a lot more negative than what most people were thinking. And we saw prices drop well below the cost of production. You know, we did see several ethanol plants slow down. Some of them idled for several months. And we're just starting to see some of those guys come back on. However, now, you know, heading into the winter with cases going back up and, you know, certain areas of the country starting back lockdowns, I see demand issues, you know, raging their ugly heads again here. So I think these next 2 to 3 months are going to be awfully interesting. And I'm not sure this whole COVID story is totally behind us yet, as far as, you know, ethanol is concerned. While we do have some people snooping around for maybe some additional ethanol exports, you know, I've seen several ethanol plants drop bids out and come out of the market here March forward. You know, ethanol margins are near zero. You know, there's a big difference between dry and wet mills as far as their profitability. So I think this is a story that, you know, 3 to 4 months down the road may be behind us, but we're going to have some rough waters ahead of us here for a while. You know, when we're driving, you know, 10, 12, 8% less, you know, it's just hard to make up for that demand. And like I'd mentioned, several people, because what Bernie mentioned, the USDA changing several numbers throughout the year as well, we're definitely caught out of position heading into this fall and when they started changing those numbers. And so it has caused a huge spike in price. We've got a lot going on weather-wise around the world, you know, with weather. So I think this upcoming 3 to 6 months is going to be awfully interesting and awfully hard to predict too. And we have, I think, a lot more outside risk in our agriculture markets than we've had in a long, long time.
So what are you doing differently in modeling and trading? How are, given the data inconsistencies and the uncertainty throughout both supply and demand on COVID, you know, how are you using data differently? How are you, you know, what models changes are you making, both in how you analyze the market and how you trade?
Okay, I'll go
Bernie?
first. No, Jared, why don't you go first?
Well, as far as our strategy, you know, we're very much a fundamentally based strategy. So we look at, you know, SIF markets and barge freights and where different rail markets are trading, et cetera. So what we have done, and since we've seen some additional volatility in these markets, we've had to reduce position size. somewhat really tighten in our stop losses and really try to control volatility that way. 2020 reminds me of, if you think it's impossible, it probably happened. So, we saw a lot of things really disrupt the markets we watch throughout the year. So it caught us getting chopped up a little bit more. So what we did honestly is just for the most part reduce trade size, be a little bit more disciplined in entry and entry points. So we've had to let a few trades that we wanted to get in go. So it has caused its challenges, and I think these next couple months are going to be that way before we get back to kind of a normal trading environment.
Bernie?
So, well, there's two things that if we think about is that when you look at the trades, what happened this year, we had a $3.50 rally in beans, and we had a pretty dang good rally in corn, probably $1.50 almost. But what was wild about it, and you think about what people have said previous to this, is that, and James made this point, is things that took 8 or 9 months now take about 2 weeks, okay? But we had this $3.50 rally, and we never had, maybe, Jared, tell me I'm wrong, I don't know if we had one day over 40-cent rally, on soybeans, close to close from the previous day. So what happened was everybody's off base and nobody really moves, and it just grinds all the time. And 2/3 of the profits, okay, so let's say you bought at the lows and let's say you sold at the highs. 2/3 of your profit was coming from the close to the open as opposed to the open to the close. So it gets really hard, and Jared's got a point. You kind of got to bring yourself in because it's so confusing as to what goes on during the day. But the trade has been like much more consistent, not as perfect, but much more consistent overnight. And maybe that's an impact of China with all their grain purchases. And maybe that's an impact of, say, palm oil out in Indonesia. So if you think about people mobility, okay, when you harvest palm oil, the best harvest you have is when you're chopping those nuts off the trees. If they get to fall down below and hit the ground and all that and sit on the ground and you wind up picking them off the ground, your yield could drop by 20%. Well, the people that are in like other countries like Myanmar and all those other places, they usually get shipped in to harvest the palm oil, but nobody would let anybody in. All the countries closed down this year. So we have demand for vegetable oils, and the cheapest vegetable oil in the world, palm oil, you just can't buy. I mean, there's nothing around anymore. It's amazing. And then you turn around and you get your report last week up in Canada, and canola. they got no canola. And this is a country that basically got stiff because of that whole, taking that gal that was off of one of those companies, and we shipped her to the United States. And so China decided not to buy any more canola from Canada. So Canada's actually been having a difficult time selling canola to China. That doesn't really work. And yet they still wind up having no canola because all the other vegetable oils got misrepresented. The USDA misrepresented the amount of beans. We have this problem in Indonesia. So the two things that are really interesting is that we've lowered, if you are successful and your time frame is a little bit longer, your velocity of trades has gone down. If your time frame is more opportunistic, you don't seem to be able to stay with the trades long enough or capitalize enough on them. So that's the thing that I think is really more interesting than anything else, on top of the fact that the spreads moved almost as much as the outrights, because we were so concerned about the beginning of the trade versus next year's harvest.
So you talk about spread trading, and maybe that's a good time to focus. Over the last 9 months in energy, we've seen some extraordinary spread moves, especially between the front and the middle. But now that we're 9 months in, we're actually in some ways seeing, more of a return to normalcy. How has COVID affected the spread trades? Has that given you more opportunity? And what's that done for storage in general?
Okay, I'll go first this time. So a couple of things is that I think that people saw the higher prices. Okay, the farmers saw the higher prices, and they wanted to, people were saying, hey, you see $4, you haven't seen $4 corn at harvest time in 5 years. You got to empty your bins. You got to sell everything. And so allegedly the farmers don't have much product. And then on top of that, even more significant than that is the people the consumptive commercial users, the people that buy meal to sell, to feed chickens and pigs, and the people that buy corn, but not as much, but the people that buy meal, they were buying for years, 4 years on an as needed basis. And now all of a sudden, they don't have the crop at the end of the year, and we're selling all this stuff to China, and nobody's got any extra inventory. So these spreads exploded into late October of this year. And Andrew, just like you're saying, things are coming back to normal. We didn't think we were going to have any beans at, let's say, January to sell to anybody, because Brazil's crop is going to be coming in late because they had the La Nina effect. And next thing you know, all the crushers are kind of full on beans. So these spreads have come back. But oh my God, it has been really hard to be able to manage your way through those trades, I think.
I couldn't agree with you more. I mean, we started with the COVID. We've had the trade wars the last couple of years. So we were waiting on China to buy. And it's not that like we haven't shipped them soybeans before, but it seemed like they all came at once. And then with a matter of 8 to 12 weeks, it seemed like they bought pretty much the year's supply of beans they needed for shipment between November and January. So it really did force farmers to move soybeans. They, like we mentioned before, they've been growing stuff below the cost of production here pretty much all year. So they'd finally gotten to some profitable numbers. So they were excited about that. After the year they had, and with the government assistance, it probably turns out to be a pretty good year for them. So I think they moved an awful lot of beans. I think we're seeing that right now, like you'd mentioned, Bernie, about bean carries kind of coming back in. However, what I will say is the amount of beans that we moved here locally in the central U.S. out of Illinois, along the rivers, Indiana. I kind of wonder what happens when we get later on into the late spring, early summer time frame, because we moved so many beans out. Was this crop size maybe even a little bit smaller? Does carry out come down a little bit more? I mean, with some of the oil problems, we've mentioned here, it's going to make, I think, for an awfully interesting year. And I'm not so sure that the story's done yet on these spreads. Farmers, because they sold out a lot of their beans, had a lot of cash, and they were able to hang on to a lot of their corn. So I think it's kept corn spreads a little bit tighter than what fundamentally they should be right now. I mean, China's still a big, how much corn are they going to import here? Are they going to take more? There's a lot of stories still to play out here in these grain spreads.
Well, I think if you think about what happened, okay, so think about this whole thing, right? Our bean prices go down into the first half of the year. They start to bounce back up in May. And in March, we had that little rally because we didn't know if the Argentines were going to be able to get to the ports and work at the ports. So we had this meal squeeze. We wound up seeing, because the depreciation, COVID caused a depreciation in all those, I don't want to say like developing country currencies, but the real and particularly the Argentinian peso got smoked. Well, if you're a Brazilian and your real to the dollar is what it is, getting cheaper and cheaper, and you're pricing your beans in dollars, you want to you're sitting there thinking you got $9 beans and $9.50 bean equivalents to hedge. So they sold 60% of their crop, their forward crop, in June, July. And I mean, I think they were fully on done, as opposed to they couldn't sell anymore. They had no more beans because China cleaned them out. They had no more beans on ground anywhere. And now I don't want to say they've oversold their crop, but I think that's what caused a complete panic that we saw going up to $12. And I agree with you. If they have a crop problem down there and we don't have inventory, where are we gonna, who's gonna crush? Who's got the beans to crush? And now all of a sudden you're gonna have, basically, you're gonna start to cut demand because you gotta do something, you know, if you don't have the product. And it'll be interesting to see what happens if there's a difficult weather that continues on through March.
So we had an exciting 2019. It sounds like 2020 was just as exciting. I love hearing the passion on the ag trades. It's good to see. Given all the activity of the last 2 years, where does the market sit today in terms of volume, open interest, investor participation? You know, are you actually seeing the investors come back?
I mean, you know, volume and open interest has been good, very strong on this rally. It's high as far as investor money coming in. I mean, you look at what you know, fund positions. While they haven't been record numbers, they've been up there. So I think the precipitation or participation from the managed side is you know, it is fairly strong. Is it as good as it's ever been? Probably not. And I think part of that is, you know, we still have some money on the sidelines potentially. And I think as we get through, you know, the South American weather, I think there's a lot of people waiting, a lot of people ready to jump. And, you know, we could potentially have, you know, more money in this thing over the next couple months if we continue to have some issues down south and around the globe, really. You know, we've had problems in Russia, Europe, you know, you name it. It seems like somewhere this year is added to the shortages that we're starting to see or have been seeing.
We're also seeing index buying more than we've seen in, say, in the last 5 years. Because if you go from, say, 2014, when we had like almost the perfect hothouse summer, you know, it rained all the time, it never got too hot, and we really misestimated the crop size, and we dropped beans probably down about $2.50 between May, June, and October of that year. And that kind of shut off a lot of personal enthusiasm and excitement in our space. So it's kind of been the lost child. You know, nobody really cares about agriculture products. And then all of a sudden this year, you know, you turn around and there it is. So it's not like we've got, just like Jared said, it's not like we got record open interest. We've got good open interest. But I still think if we have another interesting summer for us weather-wise, or this La Nina keeps on going into the spring, we're definitely, I mean, there's no way we can, I mean, we still could go a lot higher. So rallies get people enthused. Rallies get like the open interest. The open interest doesn't go up as much in price declines.
I can tell you at the macro level, we're certainly seeing increased investor interest for long only, and as you said, indexed products and commodities. And a lot of the big research houses have clearly been pushing the long commodity trade for good or for bad. You know, one of the things that potentially worries me is, you know, when you just have blind buying, as we've seen in the past in energy and other things, it can do as much damage as it can good in terms of overproduction and eventual declines. You know, what are the risks at these high prices as we come into the new year for agriculture next year?
Well, okay, so that's a great point, Andrew. I don't think the risks are quite as bad as we've had before. In 2012, when we rallied beans to $18, we rallied corn to $8, we rallied wheat to $12. We were the dominant producer of corn in the world, okay? We were much better in terms of production for wheat in the world because Ukraine and Russia weren't there yet. And we had the majority of soybeans in the world. Those prices got every one of those countries, Brazil, Ukraine, Russia, they all looked at what was going on and they're like, hey, we got to expand acres. We got to start growing this stuff. So you couple that with the fact that the genetics in the seeds have been so good that we've been able to really, like, you try and snap a corn stalk, good luck. It is unbelievably strong because the genetics are so strong. And so we've been able to grow stuff, like we can grow wheat on a sidewalk, we can grow corn in a puddle. And on top of that, we expanded all those acres. I don't know if we're going to expand acres quite as much anymore. I think the pace has slowed down. And the demand always keeps going, you know, the world keeps getting bigger, India keeps getting bigger. They're a huge consumer of a lot of our product. China, you know, you take, I don't know, what is it, Jared, 10 or 15% of the country is really arable that you can grow good crops on. So you got all those people that are going up in class, like say lower class to middle class or whatever you want to call it. Their demand for protein is not going away.
I agree, and I think our margin for error, even heading into next year, is going to be razor thin. I mean, we're heading into a winter here with extremely low soil moistures. You know, we've printed in what, $4 or $5 trillion. Who knows how much more we're going to print? So I think just the inflation picture there, you know, is a story that could be into our markets here that we haven't even yet seen. Demand is continuing to be strong. China's rebuilding their hog herd. They're going to need to be importers of more corn. They had a carry out, according to the USDA, of, you know, half the world's demand here a couple years ago, and now all of a sudden, you know, that's gone. Now, how good or bad that number is very debatable, but you know, the demand for corn and beans and protein in general is just extremely strong. We have high livestock numbers. I don't see it as being a factor, definitely not here in the U.S. I mean, South America has a little bit more land they can bring in to a point. You know, they plan another couple million hectares this year, but the big push is over. I mean, I agree. Back in 13, 14, you know, we tore up every pasture. Any amount of land that could be farmed here in the U.S., guys were farming it, and some of that marginal land here has recently been kind of taken back out again. So I don't see that as being a real big issue, at least in this upcoming growing season.
So as we move into 2021, let's talk about some other big issues out there. I guess first and foremost on Wall Street's mind is the vaccine and the efficacy, and, you know, what happens under various scenarios next year. You know, Bernie, if you see the vaccine come out, everything work out, everyone's healthy, everyone goes back to normal, what does that mean for the market? And then alternatively, you know, maybe there's some delays in the rollout. People's estimates that this is going to peak around New Year's or in January, maybe delayed into the end of the first quarter, second quarter, and this takes over 2021. You know, what do those two different scenarios mean for the prices in the market?
Well, I think that if that happens, I think it's a positive for corn because we're going to see a little bit more corn demand. Now, Trump was trying to do E85 or whatever. So, and I don't know if that'll ever get going, but if we ever did consume more ethanol, that's a good thing. What we have right now is you got a lot of people that, because of the floods that we had the year before, and then what we had last year, and the fact that we came into the year basically at, say, 850 beans, you know, by planting time in March, May, I think you got too much corn on corn that you can't plant. So I think that you're probably not going to see more acres in corn. Maybe 1 million acres is all I think you can get out of corn next year, even with the higher prices, because it's expensive to plant corn on corn. You really got to work your land. And then we still have enough bean demand. So, but I think that is going to help like corn relative to beans. So I think that's the thing that I think what goes on. I think that our demand is going to be better. The other thing is that we've really changed our consumer demand. Okay. You know, nobody goes out to restaurants. Well, oh my God, think about how much meat, how much beef goes to a restaurant versus a house. And then think about how much vegetable oil gets used at a restaurant versus a house. So we've really like had problems with basically meat demand. And we thought we had problems with oil demand, but it turns out that the vegetable oils we just don't have enough of. So that one's going to be really tricky for me to figure out. But I think that the other thing you're probably going to have next year is you're going to have more heavy cattle, which requires more feed. Okay, because if they're not selling as many, if they're not slaughtering as many cattle, you know, maybe we use more feed demand. The USDA clearly underestimated feed demand, although that's their plug. But I think they clearly underestimated feed demand all year.
So Jared, what about you? What do you think of the two different scenarios, sort of the quick vaccine fix and then the prolonged sort of COVID nightmare?
No, I agree with it. With a quick fix here, we get ethanol back to hopefully profitable levels, or at least, much closer to break even, where, it improves corn demand. We have restaurants coming back up. Last year when we shut restaurants down, people were changing feed rations to slow the weights of gains. I mean, we couldn't get animals to the slaughterhouses. It was a nightmare. I mean, you had people, euthanizing, birds and hogs and that. So, it's definitely key that, hopefully sometime by February or March we can get this under control. And I agree, it's gonna increase demand for both corn, probably corn more specifically than soybeans. If we slide into a terrible winter and we have more shutdowns and we have something similar to last year, I think it could be devastating. These guys have taken one gut punch. Can they take another one? There are some companies that probably can, and some that may shut the doors permanently. Not to say they won't be picked up from someone else for pennies on the dollar, but demand will definitely suffer if we have another year like last year, and some of that demand may be gone for a while.
Gotcha. One of the things we really haven't talked about so far, as we're most of the way into this, is regional variance and sort of regional trades. As the ag space, you're used to weather variances, but due to demand variances, what have you seen in terms of locational basis trades and the effect on shipping costs? As the whole global infrastructure sort of changes its pricing.
Well, we found basis levels were really different. East Corn Belt versus West Belt, and look at the river system now. I don't know if they could handle all this shipping. So I think that's something to think about. The other thing that's kind of interesting is that, and just kind of going forward, the river system in Argentina. Okay, so in Argentina, they're the biggest meal seller in the world, right? What they typically do is they crush everything. They don't sell beans to anybody like they sell meal and oil. And their river system is really low, and this La Nina is going to make it really low. So all these things are having basis implications like we've had, and just like going into December with the buying as needed, basis relationships, both cash to futures and the calendar spreads, they were evidence of the fact that people really didn't forward price themselves properly enough. So I don't know what happens next year, but I do know that one thing is that, and this is something else that's going on. If you go to a far western soybean crushing plant and talk to them about what's new going on, they've got all these companies like Marathon Oil and all these people that want to take down all their bean oil going forward because California, Oregon, and Washington are gonna like they're eventually gonna like do no pollution, and they're gonna create much more biodiesel, pure diesel, it's called, than what everybody else in the rest of the country is going at. And the problem when you go that far west is that we don't grow beans that far west. So they're going to pull them from the west side of the belt. And I think that could change basis relationships. That's something we got to think about.
I agree with you. Another thing that's going to really wreak havoc with some of these bases that you were talking about, Bernie, is the Ohio crop is pretty high in vomitoxin. So, you know, we've mentioned some of these end users have not done a very good job with forward coverage. You know, it's already showing big differences between, for example, paper trading or just, for example, a Columbus market rail bid versus a certain origin that has better quality corn. In some circumstances, as much as 6 or 7 cents difference. We've seen big swings in the rail markets, and I think that's something that probably continues. Just in the last couple of days, it's dropped, you know, 11, 12 cents. We're seeing a lot more corn being pulled, you know, west over east because of these issues. So it's going to have probably a bigger impact on the river, especially as we come, you know, later on down the road when we get more into a corn exporting program than it has in maybe years past. So I think there's other things besides the virus here that's gonna make this next year pretty challenging for that area.
Gotcha. So as we come to the end of what's turned out to be a really interesting and great panel, are there anything that you guys want to close with on COVID and sort of world changes here?
I think, Andrew, I think you had some good questions. I don't know. I think you covered a lot.
Well, hopefully we'll have a third year of good volatility and interest. Jared, anything you want to close with?
No, I agree. I think we covered a lot here, and I think next year we're gonna have that volatility, at least in the ag space. I think we're gonna have a lot of opportunities that you know, this presents, and hopefully, you know, we can take advantage of them and, you know, do a good job.
Guys, I don't think you saw the one question in the audience.
I just saw it.
Okay, so real quick, what is the outlook for Ukraine's production into the future? Recently, land reform laws have been set into motion.
Okay, so, and Terry, you could probably speak better on this than me even, but so you look at a couple things. Ukraine has really expanded their corn crop over the last 4 years, unbelievably. And they have areas of their space that also grow a decent amount of hard red wheat. Their land reforms, they're going to expand more and more out there. Probably, if you look at all the countries around, I don't think it's going to be Russia. I don't think it's going to be Brazil as much. Brazil was the leader in acreage expansion. I know it's not going to be Argentina, and I think it could be Ukraine. They have a reasonable, although it could get dicey, a reasonable distribution network. And the other thing is that area of the world, the demand for wheat is really strong. And we can never sell wheat there because their transportation costs are so much better than ours, regardless of any other fact. They don't have so far to go. Egypt's right there. Tunisia's like a lot closer than it is for us. So all the major players that buy wheat, they're going to be satisfied with Ukraine, and Ukraine can expand more because Russia's still the pricer of wheat in the world. Everything that gets priced in wheat, they are where the supply meets demand, and they set the world price. If they don't have it, they pull out, and then other people sell and they get drained and it goes higher. But if they got it, they sell it.